What's up, YouTube? Stocks by the numbers, back in action here. Welcome back to the channel. Wanted to do a video on a brand name company here, Dow Component, that someone asked me about. And I know they've been struggling over the last couple of years, but we're looking at an all chart here, and you cannot deny the growth over the decades of this brand name company in 3M Company, ticker symbol MMM, listed here on the New York Stock Exchange. Stock closed 104.54 a share, up 73 cents, about 0.7%. And basically, this company has been struggling for the last couple of years. However, again, for the 60 years before that, has been an absolute powerhouse. We have a market cap of $57.67 billion. The company is paying out an extremely healthy dividend, which right now is yielding 5.75% for you to own shares of the stock. PE is sub 11. So on paper, the company hands down looks undervalued. And of course, they have been taking the Dow higher. This is a Dow component, so of course, even though they are beating it up, it's either not going to go as low as they want it to, as quickly as they want it to, but more importantly, it could even stay flat and stable when it should be maybe technically down. But here, you can see the company has beaten on the EPS side 3 of the last 4 quarters, and it looks like the revenue was maintaining like that $32 billion mark for several years, and since jumped up to about 35.35 here in 21, down to 34.23 here in 22. So now the company went from, again, like the low high 32s up into the 34s and the 35 billions, and you can see also coming even off of that jump, the profit margin back here at 32 was about sub 17%, and you can see still maintaining 16.75 profit margin, 16.88% profit margin. So, you know, the company, just like always, is kind of rolling on all cylinders, even though if you look quarterly, you can see there have been slight decreases in the revenue here, 883 down to 87, 862, 808, 803. Now, basically, some of these profit margins, kind of pulled back slightly for this company. Several of their expense figures, like the operating expenses and the cost of goods sold, have been increasing. So that's why, understandable here in like the last year and a half, 2 years, the company has been struggling as of late. However, a lot of companies are still kind of struggling to get back to where they were pre-COVID. And as we see here, the company has actually taken the next leg higher and is making a little bit more revenue. But again, if the expenses increased along with it, it starts eating away at the margins, and you, I guess, can't be rewarded too much for that. But overall, this is basically our long-term trajectory, and you can see here, going back even to the early 70s, the stock is basically in this upward trend. You got your little parallel railroad tracks here. It looks like a blue chip stock that consistently grows over the years and increases its dividend payout to you. And this company's been paying dividends for like upwards of 60 years, just consistently increasing them overall. But, here on the chart first, before we quickly look at the numbers, you can see, these were our last highs here, in my opinion. Looks like a line, we'll call it about like 97 or whatever. But you can see here, even as of late, they brought the stock down here, and you can say broke that long-time support level, and then they immediately popped it back up. Right? So that's why if 97 is your low and the stock right here is 104.5, if you're looking to consistently piece your way in over the years, could it drop a few dollars? Yeah, of course. But if it's at 104, you're telling me the lowest it can go is 97, plus they're paying me almost 6% to hold it. Kind of a wash, right? Not really the biggest of issues if you're looking at it like that. But overall, since these highs here, as you see, 2018, and then we're consistently dropping down over the years, and now we have our low here, of course, March of 2020. So if we draw our trend line there from the bottom, and then we draw a trend line here from the top, going into, looks like, like the mid-tail end of 2021, these are the red lines. I know it's hard to see, but it's basically a descending wedge, which a lot of stocks that we look at have really been in since the drop and height recovery after pandemic. So if this is true, then obviously within the potentially next 2 to 3 quarters, you can see a breakout of these red lines here back up to perhaps this purple line. But even as of late, I know there's a lot of trend lines going on. Just try to stick with me here. I tried to make them different colors so you guys can kind of differentiate them. But, again, going back to, what is this, basically since the ball dropped, A year ago. Oh, excuse me. I thought this was January 23. So, okay, this is about the last like 18 months. You can see that they kind of been bouncing the stock around, and it's in this downward trumpet pattern. So, again, they really don't know where they want to potentially take the stocks here. This was the original path that I drew out, this dark blue. I looked at the company like 2 weeks ago or something, maybe around 2 weeks, and obviously, it just so happened to move on this path, but I'm not really patting myself on the back for that one. But again, the stock was most likely going to drop down as they paid out their dividend, and then you can see broke that trend line and then immediately gapped up back above it and began to climb. So now obviously we're basically in our rising wedge, and it's only a matter of time before we break down again and begin to bounce around. Here's next quarter's earnings here at the end of July. So the stock is most likely going to run up into those earnings. And that's why, again, if the company really announces some sort of phenomenal restructuring and gets their expenses in order, but consistently, increases profitability and keeps revenue growing, then you could have a breakout here. But chances are it could potentially stay in this long-term descending wedge for the next 2, 3, potentially even 4 or 5 quarters. So, might not be your high flyer. However, the company isn't going anywhere. They're consistently increasing the dividend for you to own it. Nothing wrong with a long-term drip investment, 5, 10, 20 years down the road, consistently adding shares to a company like 3M. Because again, looking at the chart, going back, right? I mean, look at this trajectory. And this, again, this right here was COVID. So that's what I'm saying. Like, if that didn't happen, chances are it would have, bounced around the middle of this long-term railroad track, and it probably would have bounced back up and ran back up. So the company was well over 200 a share. Now it's down to 104. So that's why, again, it could take a while. As you see here, I have like some run-ups happening coming into earnings, which is usually what happens. And obviously I have the big breakout. In my opinion, I'm projecting all the way here next year. Roughly 7, 8 months down the road here from where we are, and you're looking at the first quarterly report going into 2024 potentially. But again, the long-term, the trend lines, the pattern still seems kind of wide. So that's what I'm saying. The stock really could bounce around here, and then you're going into you're going into May would be the next quarterly report, which obviously is closer to the apex, but it could go out even further to July, August of 2024 before this company really breaks out. And reason being, let's go to the financials. Right? So first of all, again, very stable company, very nice. They're in a lot of sectors. We're in the whole world. Okay, beautiful. 4 beats in a row on the revenue side, and of course 2 for 2 on the yearly EPS estimates. But look at this, $5.44 a share. Up to $5.76, right? 22-cent increase. Up to $5.88, 12-cent increase, right? This is where it started to get difficult for the company. So we're at $5.88. Everything got shut down, whatnot. Then we go up to $5.92, right? So now we're at $5.96. So they're basically just increasing it kind of because they have to, right? And they're not increasing it, obviously, as much as they were back in 16, 17, 18, 19, before it started to get rough for them, and, of course, before pandemic happened. And you can see the debt actually increased and jumped up to $21.3 billion right here in 2019, before everything, obviously, got rough and got shut down. And since then, though, has actually been decreasing down to 19.7, 18.3, down to 16.8. So the company, again, yes, you can say, oh yeah, free cash flow and, cash on hand has been decreasing for the last several years. Yeah. However, the company is paying back its debt, obviously, and limiting the debt on its balance sheet. And even though they have taken on more liabilities in the last several years, obviously to keep everything copacetic, assets are still outweighing liabilities here. So that's why it's, there are some negative metrics here, but at the same time, obviously, overall, it's really positive. The cash has been bouncing around. Assets, again, were at low, like mid-high 30 billions for several years, and now in 1920, that's when they've taken the next leg higher into mid-high 40 billions. And again, you can see liabilities made the jump as well here from 26.65 billion up to 34.5 billion. However, since then, you can see, look, 34.41, 31.95, 31.68. So, they're maintaining their assets and the business overall. They're maintaining the revenue and their profit margins, while at the same time, again, limiting on the debt and lowering liabilities. So that's why, they may want to punish them and hurt them for this like 2-3 year period here. However, overall, I do think that they will come out of it, with flying colors, and everything will be fine. Book value per share, this is interesting as well, because again, they've been beating up the stock for the last like 2-3 years. And if you look here, this is the highest the book value has been going all the way back to 2016. And basically, since it, quote unquote, got more rough at the company and the stock has been getting beaten up, coincidentally, the book value per share has been increasing that entire time that this has been taking place. So that's why, again, you could understand as to why they may be viewing it as a negative and bringing it down in the short term, but overall, again, the company really should be fine, technically, in my opinion. The cost of goods have significantly increased, as we see here, was about 16 up to the high 16 billions, and then since ballooned up to 18.75, now 19.25 billion for cost of goods. Total revenue minus cost of goods is a gross profit, so obviously that is the lowest it's been going all the way back to 2016. Gross profit minus operating expenses yields operating income, which is down at 4 billion, the lowest it's been going all the way back to 2016. But again, the operating expenses were about 8.5 billion, jumped up to 9, jumped up to almost 11. So that's why, again, this company just basically, I think, just has to get back on the track, get all their ducks in a row, and again, down the road, I do think they're going to be unstoppable once again, right? All companies hit little speed bumps and have little hiccups. The PE, again, obviously the stock has been selling off, so the PE is sub 11, lowest it's been going back to 2016. Same thing on the price to sales ratio, same thing on the price to cash flow ratio, same thing on the price to book ratio. The stock has been going down, book value has been going up, so now the stock is trading less than 4 times book value. So that's why I can appreciate the fact as to why a lot of you may be looking at or have already taken a position in 3M. It's very understandable because it definitely does look attractive here in the numbers. Obviously, some of the metrics have pulled back. Return on assets has been slipping a little bit, now back down to sub 12%, was above that for a few years. The return on equity has kind of just been slipping year over year. And the return on invested capital has actually been maintaining like that 18.5% mark. Gross margin percentage, again, was up to almost 50% and has since pulled back here, sub 47%, sub 44%, now 42.25%. So this is what I'm saying. That's why when they see some of these margins going down, they want to try to justify, selling off the stock a little bit and bringing the price down a little bit. Operating margin basically got halved from 20, 22, 23% down to sub 12%, but now it's back up to north of 15.5%. So that's why the company, as I said, right now in the short term might be a pain in the ass to deal with, but in the long term, in my opinion, I think you're going to be fine. The EBITDA, again, was in the high 20s, really, and then pulled back to about 17.25%. Now it's back up above 20. Sitting here at about 21.4%. So, again, the company just getting all its ducks in a row. The net margin right now has been taking a little bit of a hit, as you see here, down about 25% here, was maintaining that 16, almost 17% mark, now down to about 12%. And, of course, the inventory turnover that we've been looking at as well, you can see was up to 4.38, kind of really just a touch below 4 for several years, broke up above 4, and now pulled back to 3.72, now 3.62. And the asset turnover as well, technically, supposedly, how much income their assets are generating. And you can see was at 0.92 and has just been really consistently slipping and bouncing around. Got back up to 7.5, then 7.3, now sitting at 7.2. So that's why, again, looking at, most of the numbers beginning to rebound, but of course, still having some negatives, kind of understandable. The company apparently is has a lot of litigation hanging over its head and could potentially down the road be liable for, billions of dollars. So, that's another reason why they're beating them up. And of course, they've been paying out less to shareholders over the last 3 or 4 years. So usually when a company pays less dividends, the stock price goes up, but it's been going down. So, that's why, again, it's kind of understandable. But even looking at the projections here, they have a pullback on revenue of sub 32 billion for 23, but then back up to 33, 34 and a quarter, back up to 35.3. And honestly, I mean, the company just did 35.3 and then pulled back to only 34.2. Now, of course, yeah, it's like a billion and change, but at that level, it's not too crazy. That's really only like 2.5–3% decrease, and that's why to have these estimates, I don't know. I have a feeling that because, again, this company is involved in just so many different products and so many different segments. But, I really do believe that they're going to be able to maintain this business. I don't know if I agree with that $32 billion pullback. And, of course, the company has been absolutely killing it on these estimates here. 6 years in a row, the company coming in above analyst expectations on the revenue side. So that's why, again, I'm really not too concerned. 2 misses on the EPS side here going back the last 7 years, but again, very, very slight misses here. This is the biggest one, missing by about 15 cents a share. Here they missed by half that, about 8 cents a share, less than 1%. So that's what I mean. Even when they do bad, it's really not that bad. But technically looking at a lot of these numbers, again, looking at their segments, how it climbed up to almost 13 billion. Now last year 11.6. That's why seeing some of these numbers, 977 down to 89. That's why you can appreciate, you should be able to appreciate the fact as to why the stock has kind of been pulling back. Again, you can see Asia Pacific down, Europe, Middle East, Africa down, right? China, Hong Kong down from those highs there of 4 billion. But again, before that was 3.5 billion. So still sitting at 3.8, it's still not too bad. That's what I'm saying. A lot of times these stocks get severely punished in the immediate short term. And, again, it's usually an overreaction. And as a shareholder, you should, just take it on the chin. You got to take it in stride. But again, this situation is more of a long-term play, not really a short-term play. If you do want to catch it bouncing off one of these bottom trend lines, like here when it broke like 94, it looks like, and broke that trend line, if you wanted to roll the dice down there at like around 93 and step in and buy like some $100 calls, obviously you are sitting pretty. You made some really nice returns there. But again, I would basically just wait for it to, like get beaten up and get down towards the bottom of that range before stepping in and trying to time a bounce, or maybe like 2 weeks before earnings. As you can see here, I have the little run-ups going into earnings. So, again, there are ways to play it in the short term, but overall, in my opinion, it's really a longer-term play. Switching over here to stock charts, you can see on the weekly here, the RSI 47 still has room to run. However, at multiple times, you can see it kind of rose up or rejected off of that mid-Bollinger Band. So, MACD has crossed. Again, they could bring it up a couple of more dollars, but we are seeing that rising wedge taking place basically since June started. So only a matter of time before they bring it down and reject it. So that's why, again, piecing your way in here at 104.5 might not be the worst decision, random ad. However, again, is it the best price you can possibly get? I mean, probably not. Even if they just break it out of this wedge short term, they can bring it down here to the 50-day moving average here on the daily of about 100 and change, right? So you can say, oh, why buy it at 104 when I can wait and get it at 100, right? So that's why, again, long term to piece your way in, phenomenal company. In the immediate short term, do you have to buy it now? Probably not. It's probably going to pull back a couple of dollars soon, and you can get in at potentially around 100 or even sub 100 there in the mid to high 90s. The MACD obviously has been climbing for the last several weeks, and you can see the giant wedge triangle upward that it's forming. So it's only a matter of time. It could pop up to 105.5, hit the top Bollinger Band, and then boom, hit the apex and break down. So, again, RSI on the daily here at north of 60 now. So again, it could run up for a little bit, but it's only a matter of time before it's going to pull back. So I wouldn't chase it, and I would be patient here. That's just my opinion. But again, really, I think they're keeping it down because of the all of these trials and whatnot, all of this litigation that they're dealing with here. But there were a couple of articles I wanted to show you guys real quick. Like here, this guy talks about like 3 dividend kings to buy if times get rough, and the first one he talks about is 3M. At the time, right, the yield was at 5.85%. Safety and healthcare, transportation, been around since 1902, right? Drastically in the month of May. This came from weaker economic outlook coupled with weaker production in China, right? So that's what I'm saying. The company's dealing with a couple of speed bumps right now, but overall, even this guy knows here with the healthy dividend to hold it for long term and to do that DRIP, again, DRIP, dividend reinvestment program, to do that over the years, you're going to be sitting pretty down the road with the stock like 3M. During the company's earnings report, management remains steadfast that 3M stock should recover by the second half of 2023. Major restructuring, look, laying off some people, working on its supply chain. That's what I'm saying. They got to get their logistics going up again. The company, again, was on such a phenomenal road upward over 50, 60 years straight. Then all of a sudden, the pandemic comes, and if you're the CEO behind the steering wheel, all of a sudden, boom, someone just threw a wrench into your engine, and now you got to pull over, you got to reposition everything, and you got to get it going back on track again. So that's why, it could take 2, 3, even maybe 5 years since 2020 before these companies really get rocking and rolling again. But, basically they seem to be doing everything they need to be doing. We got announced it would be investing 146 into biotech manufacturing, right? So it's been lucrative, led to a share price of 13% practically overnight. So that's what I'm saying. In the short term, could get rocky. In the long term, probably going to be a winner. Probably going to be a winner. Currently holds 65 years of dividend growth behind it. Continues to trade at a valuable, at the time, 10.88 times earnings. So that's why, again, really just a powerhouse. But again, here, litigation. Was this the one? No. But again, basically, they have a lot of suits taking place here. Settlement of at least $10 billion with several U.S. cities. Oh no, wait, that wasn't them though, right? There was another article. See, now I can't find it. My apologies. Stick with me, baby. Stick with me. Yeah, I think it was this article, perhaps. Seeing 3M appears to have larger PFAS liabilities than any one of the DuPont-related companies. Bloomberg reported Friday that 3M was in talks for a similar settlement in the range of $10 billion. 3M didn't immediately respond. Stock was up 8.4%, which has about $4 billion. 3M has been dogged by legal woes for years. Wall Street estimates for the total litigation overhang in 3M stock is in the range from $30 billion to $40 billion. Right? So that's like 60% of their market cap right now. This is why the company has been in a downtrend. Analysts typically around the limit, taking a fair price there, any range over 3M stock based on history and working on the market. Current market cap of $56 billion, right? So they're saying they could potentially be on the hook for $30 to $40 billion. Right now they got market cap $56 million around. So useful one for investors. 10 times estimates, nearly half the S&P 500 multiple of 18 times estimated 2024 earnings, right? So that's what I'm saying. If you just want to look for the metric that makes it look good, it's got a low PE, sub 11. Yeah, true. However, again, the company may have to down the road write, check after check, and it might cost them $30 or $40 billion. So again, there's a reason why these stocks go down also. That's why I always tell you guys, don't just say, this went down, it's got to go back up. That is an interesting strategy, and it could work out for you more times than not. But again, on the flip side, you have to look at the why. Why is the company down, right? 3M also faces liabilities from potentially faulty earplugs sold to the military, right? So that's what I'm saying. This company has a lot of crap to go on to, and that's why my projection here of just kind of like having these little pops and drops and just basically kind of just projecting the middle of this overall range here and just kind of like staying in the middle downtrend, like just waiting down the road 6, 9, 12, 15 months down the road before they get all their ducks in a row. Hopefully they take care of all this litigation and the settlements aren't as out of hand as it sounded right there. And, again, that's what's going to help break the stock out over time. But I do think it's going to take time. But overall, look at that chart right there. 3M, there are worse companies to buy, right? But I'll end it there. So once again, Stocks by the Numbers. Thanks for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Join the Discord if you'd like. We can have a little BS, go back and forth in stocks around there. Like the video, thumbs up. Algorithm helps me get more eyes on the channel. Subscribe to the channel. Means a lot to me. Moving forward, I hope everyone has a great weekend. Happy Father's Day to everybody out there. I wish everyone success, and let's make a couple of dollars.